Hello everyone, welcome to week 6 learning videos once again, and this is the last learning objective today. In this learning objective, we discuss the implications of the academic evidence on the success of momentum investment strategy for traditional technical analysis. So we are basically going to link between the momentum and traditional technical analysis. It's important to start by noting that momentum is, in the academic sense, is different from what we would traditionally pick up in any technical analysis. Because most academic research studies momentum, which is basically cross-sectional momentum, where we rank stocks based on their past performance and we buy those stocks that perform relatively well over the past intermediate period, and we sell those stocks that perform relatively poorly. However, given some evidences in the academic literature of time series momentum, this would appear to provide some scientific justification for technical analysis. Technical analysis can be seen as a form of momentum-based trading, particularly time series momentum. Technical analysis involves forecasting of asset returns using historical prices. Also volume and other measures that try to capture supply and demand in market prices. So when we look at the relative merits of technical analysis, what we might see is that research shows that the time series momentum strategies do appear to generate abnormal return. But the key caveat is that most academic studies don't include market frictions like transaction costs. And one of the big problems of technical analysis is that often it requires frequent buying and selling, which can increase transaction costs and also increase exposure to taxes. The basic principle behind technical analysis is that prices is purely determined by the interaction of supply and demand as opposed to fundamental factors. While those fundamentals might overlay the supply and demand decisions that are made by investors, what we find is that there are both rational and irrational forces that govern investor decisions whether they want to buy or sell particular stocks. Therefore, what we might find is that stock prices moving trends persist for some period of time because those trends are related to trends in investors' views on stocks and trends with respect to supply and demand. So basically the idea of technical analysis is that you can pick up a trend in prices and hence potentially an abnormal return if you can identify factors that result in a persistent shift in the demand and supply of a particular stock and the particular trend. So the arguments regarding technical analysis is one that it's been around for a long time. We can look back 80 years for one particular argument as we have seen here in the slide. This is written by John Magee on technical analysis, but also the work of Robert Shiller, for which he won the Nobel Prize, used a similar point. So what's the point? Stock prices that are only governed by changes in fundamental values should not fluctuate too much. So, if stock prices only governed by changes in fundamental values, we should not see the changes of volatility of prices in terms of what we actually experience, particularly during the global financial crisis and maybe during dot-com bubble. So look at the quote on the screen. Here is the argument that back in 1930s, one share of US steel was worth $261 in the early fall of 1929, and then only a couple of years later it decreased to just 10% of its initial value to $22 by June 1932. 5 years later, the price is back to $126, and then 1 year later back down to $38. So what's my point? What's the argument? The argument here is that surely the fundamentals of US Steel, this large company, can't change such that the fundamental values of the firm went from $261 down to 1/10 of its initial value, back up to a 500% increase, and then back down to again 25% of its initial value, all across the period of approximately within a decade. So the argument of this significant fluctuation of price suggests that there might be other factors that resulting in these changes in price. Hence, these other forces means that maybe technical analysis can identify those particular forces potentially could be able to use to generate abnormal return. So what are some of the signals investors use in technical analysis? Well, the signals people look at is the ways to identify structural changes in the supply and demand of stocks. This includes market breadth. Market breadth is basically a measure of sentiment within a particular market that is measured by the total number of stocks in the market which have advances in values versus those that have declined. So we have got a broader market, then what we will get is we will get more stocks increasing in value relative to those decreasing value. It means that demand across the market is strong and we expect to see a positive continuation in returns or a positive price pattern into the future. Volume indicators are also used whereby some traders believe that higher trading volume on particular stocks or particular assets implies higher demand for those stocks. So arguably, you might also be able to use this information in order to come up with predictable patterns of returns. Finally, is the idea of support and resistance lines. The idea of this particular technical signal is that investors, due to behavioral biases, tend to think and trade around round numbers. A round number might be a share price, say $30, and also we might have algorithmic trading where the algorithms are programmed to trade around particular round numbers. Hence, what we find is that we have these supports and resistance lines where share prices tend to bounce within a range of round numbers, and once the price falls outside the range, you then find that either the support or resistance line has been broken. So then you see a trend that's created once that those bounds have been broken, and you see a price continuation in that direction. So let's have an example of a support and resistance line. This graph shows the BHP share price for 12 months period from October 2013 to September 2014. So what's really noteworthy here is really clear that share price is being traded between round numbers. Those are $35 and $40. So every time the price goes down to around $35, it's tend to bounce back again. And similarly, when it got up to $40, it decreased again. But in October 2014, that support line was broken, and we then see an emergence of a trend. That's what is argued in terms of support and resistance lines, that price will move within a range. Then once it's broken, then you will see a trend for a period. For example, here, until a new range is established. Equally, if it pushes through the resistance line up at the top, you might see an upward trend across times. Potentially, the one technical analysis that's got the most justification and the most academic evidence behind is the use of moving averages. Moving average is a quite simple strategy that is effectively an application of time series momentum. It's a strategy whereby you look at the current price relative to the average price over the last n days, and n is often a value somewhere between 50 and 200. The reason we tend to use between 50 to 200 days is that approximately corresponds with the intermediate time period of 3 to 12 months that we look at with respect to momentum strategies. We know there is approximately 20 trading days in a month, 60 trading days in 30 months, and 240 trading days in 12 months. So using 50 to 200 historic prices to come up with a strategy sort of align with what we see with momentum. With respect to a moving average, when the current price is above the moving average or above the average price over last n days, let's say 50-day moving average. So if current price is above average from the last 50 days, then we would buy that stock. The reason being, if current price is above the average from the past, it implies that the prices are on the upward trend, and if we are believing in price continuation, we are believing that the trend is going to continue. Whereas when the price is below its moving average from say the last 50 days, we would sell the stock. Now, quite often, we actually see the most commonly used moving average strategy is 200 days. The reason being is because the longer the period that you use to form your historic moving average, the less trading you tend to. Although you might be sacrificing some information by looking at a longer historic window, there is a key benefit in that you are able to reduce your transaction costs. So let's look at a very quick example of moving average strategy based on Hewlett-Packard shares. And this is a 50-day moving average. So you can see that this blue line shows the Hewlett-Packard share price, and this black line shows the 50 days moving average. So as I previously have said, that according to this moving average strategy, when we see that our share price is higher than the 50-day moving average, then we should buy, and if our share price is lower than 50-day moving average, then we should sell. Okay, so if you look at the point here, where what happens is our share price is higher than the our share price is lower than the moving average. So what should we do is we should sell. On the other hand, if we look at point A, here our share price tend to be higher than the moving average, so we should buy. So what happens if we implement this strategy? At this point B, where our share price tend to be lower than the moving average, we expect this downtrend to continue, so we sell it here. And as our share price tend to be higher at point A, we expect to continue this trend, so we buy it here and it continue to go up. So that would give us an opportunity to earn some abnormal profit. So that's an example of moving average.